since the US and Israel attacked Iran, is expectations for US interest rates have gone up by about 1 percentage point. So if you look at what the market is saying Fed funds rate will be at the end of this year, it's now saying around 4%, whereas at the end of February it was saying 3%. So the attraction for moving money out of Japan to the United States has gone up.
Welcome. How unusual is it to see two countries, in this case the US and Japan, say out loud that they are working together to prop up a currency?
It's very unusual. And in fact, many times in the past when countries would intervene in currencies, they would try not to talk about it. No one might disclose it. It's even more rare to have joint intervention and to confirm that it's occurred. Partly, I guess, because you don't really want to disclose that you're trying to manipulate markets. You want people in the markets to think something has changed that's bigger, that's more macroeconomic.
Why is the yen falling, and why is it in the US's economic interest to help keep it higher?
There are a number of reasons why the yen has been depreciating over time. Number one, when I think about foreign exchange or currency valuations, in general, theoretically, they're driven by changes in expectations of interest rate differentials. It's a mouthful. But basically, if you think about it, if you're an investor and you're in Australia and you can only get a 3% interest rate here, but you can get a 6% interest rate somewhere else, you might be tempted to move your money to that other country to get a higher yield. So the bigger the differential, the more there's an incentive to move your money into a different currency to get those yields. Well, what's been happening this year, especially since the US and Israel attacked Iran, is expectations for US interest rates have gone up by about 1 percentage point. So if you look at what the market is saying Fed funds rate will be at the end of this year, it's now saying around 4%, whereas at the end of February it was saying 3%. So the attraction for moving money out of Japan to the United States has gone up. And I should note, by the way, interest rate expectations in Japan have not changed at all since February, so that's an extra 100 basis points net. So that's one reason. The other might be AI. A lot of money globally has been moving to the US to try to play the AI trade. And so there has been speculation that that might also be a vulnerability of the US if the AI story in any way starts to reverse.
Japan is now the largest holder of US Treasuries. The US doesn't want to risk Japan selling those off anytime soon in order to defend its own currency, does it?
The US has I think, a problem in this regard. We have over $39.5 trillion US dollars of treasuries outstanding, 31.5 trillion of those owned by the public, meaning the other 8 trillion are owned by government retirement funds and other entities. Out of the 39.5 trillion of treasuries, 9.6 trillion is owned by foreigners. 1.2 trillion of that is owned by Japanese investors. So it's 1/8 of all of the foreign holdings. So bottom line is, given that we've had many years of Japanese rates being close to zero, well below US rates, well below rates in Australia and New Zealand, for example, a lot of Japanese high net worth investors and big pension plans looked and said, we can pick up extra yield, we'll get a higher interest rate. And in many cases, they did not hedge the currency, meaning they basically sold yen, bought US dollars. And while the yen has been going down in value, they made money on the extra interest and they made money on the currency. There's this kind of balancing act for the US of we want the Japanese to be buying our treasuries, but as they normalize interest rates, at some point the Japanese yen may well start to strengthen, which decreases the attractiveness of US treasuries on an unhedged basis. And if you have to start hedging, it's not really attractive at all for a Japanese investor. And we have to fund these $2 trillion a year deficits we're still running on top of all that debt.
How likely is it that greater disorderly yen movements, as Scott Bessent labelled them, could translate to disorderly market sell-offs, not just in currency and bonds, but equities also?
Yeah, that's a tougher question to answer. I mean, I think there's always a risk that if you have extreme volatility in one asset class or one part of the broad global markets, that it can surprise people by showing up somewhere else. That you could see, for example, changes in currency affecting bond yields, which then affect equity prices. Hard for me to put my finger on a probability of that happening right now. The yen had been weakening quite materially. So with this intervention over the last few days, they basically brought the yen back to levels seen a few months ago. So I think that risk is down. The only thing I would note is a skepticism. These government interventions in currency markets tend historically to have a short-lived effect. And then the markets go back to doing what they were doing based on economic fundamentals.
But are the risks building for Wall Street? What are share market investors to make of this timing, given the global geopolitical instability and the volatility when we talk about tech stocks and earnings?
The bigger risk is exactly what you just said. It's on the geopolitical front. Iran seems to be settling again. Our geopolitical advisory group thinks that we'll be, for months now, we're going to be in a simmering conflict where periodically you get calm after a memorandum of understanding, and then you get flare-ups like we saw in the last 3 weeks. Maybe the bigger concern is on the AI story. And make no mistake, I think AI is going to be revolutionary for the global economy. It's already changing how each of us do our jobs. But the bigger concern that seems to be more and more prevalent on Wall Street is we're investing trillions of dollars in AI CapEx in the United States. How do we get a payoff on that? Investors are really questioning the business approach, the strategy, and they're getting more skeptical about the amount of debt being used to fund all of this.
Ronald Temple, good to speak to you.
Thank you so much.